We are now 1 year past the Toronto real estate market's peak frenzy, and just as I've been warning, we have GTA stats that make it look like sales have fallen off a cliff. Out on the street, activity doesn't match the image implied by the stats, with sales near the core from the last week including plenty of multiple and preemptive offers, resulting in 2/3 of East End Toronto homes selling for $80,000 to $400,000 over the list price, and even a couple of multi-million dollar West End and Central homes that went for $500,000 and $900,000 over list. In this market update, I'll reconcile the stats with what's happening in the field, I'll discuss 4 pretty terrible yet trending news items, and talk about the key takeaways for today's home buyers and sellers. Hi, I'm Rebecca Lang with my April market update for the City of Toronto. I'm going to kick things off with a look at some not very happy but educational news stories from the last couple of weeks. The first 3 are about deals going wrong, so before diving in, I must preface by saying these stories represent a very tiny percentage of transactions, and there were literally tens of thousands of successful buyers and sellers in the past year who have transacted without hiccup. It's also worth noting that these nightmare scenarios from the headlines all took place in the 905, where there were greater swings in the market. So please keep this in mind as I go through these worst case scenarios, okay? The first story is about the developer in Vaughan who canceled the agreement of 1,100 plus condo buyers before the developer claimed they were unable to obtain satisfactory financing. Buyers are justifiably outraged for a number of reasons, the main one being that during the 2 years the builder has been sitting on all these deposits, condos in this location have jumped up in value by 30%. Are the buyers going to recoup that spread? Unfortunately, no. They'll get their deposits back, but they'll have missed out on the market gains. Whether this cancellation occurred for nefarious or legitimate reasons, it will either be this developer or some other developer who acquires the property who could potentially profit from that price appreciation. As I've mentioned in previous videos, pre-construction contracts are written very much in favor of developers and allow various outs for the builder with limited penalties. If you're familiar with derivatives trading, it is almost like a developer writes a put option when they sell a pre-construction unit, thereby transferring risk to the buyers. In a perfect world, in exchange for taking on this risk, buyers should get a discount compared to current market values. But sadly, pre-construction pricing hasn't worked that way in some time. Fortunately, cancellation occurs with fewer than 10% of the GTA condo projects. It doesn't typically take years before it happens, and often there is an opportunity to repurchase in the replacement project. Nonetheless, the lesson to be learned is that as a buyer, it is important to understand the role you are also playing as financer and risk mitigator for the developer, thereby making it all the more important to evaluate that developer's character, integrity, and track record before jumping in. The second and third news stories take a look at the flip side of this, where it is a buyer who is unwanting or unable to complete their purchase. In Oakville, there's a group of buyers who purchased pre-construction higher-end homes from a developer at peak pricing a year ago. Today, as these new homes are nearing completion, some of the buyers are saying they are unable to close on their purchases, with the main reason appearing to be that the buyers' existing homes have devalued since last year's intro of the Fair Housing Act, and now they won't have sufficient proceeds to pay the needed down payment for their purchases. I'm empathetic to these buyers, as none of them appear to be intentional speculators, and they are now in a very difficult position. At the same time, the risk they were taking on at the time of buying from the builder should have been fully explained, evaluated, and mitigated. How does someone mitigate a potential loss in a home's value when that value is essential for the future purchase? By selling at the same time as making the commitment to buy and leasing until the new home is ready. This is known as buying and selling in the same market. To be super extra cautious, the proceeds of the sale can even be used to invest in a hedge against the risk of interest rate increases before closing. I know, this sounds rather impalpable and almost unheard of, but otherwise a buyer is locking in today's price from the builder and speculating that future pricing for their existing home will be the same or higher, for which of course there is no guarantee. Lesson to be learned is what I've been saying in recent videos. Before walking into a builder's sales center, ensure you have your own realtor alongside you who has a fiduciary obligation to help you protect your interests and help you identify and strategize for risk exposure. Otherwise, in terms of risk analysis, all that a builder's rep is going to ask you for is a basic mortgage pre-approval letter, which isn't good for anything if it's going to be months and months before closing. The next story comes via the courts, who ordered a buyer to pay almost $500,000 in damages to the seller after they failed to complete their purchase of a home in Stouffville. The buyers offered without conditions, and once the sale was firm, they were unable to secure financing. With knowledge that the buyers were going to breach the contract, the sellers proceeded to attempt to mitigate their losses by relisting the house for sale. Unfortunately, this all transpired last April and May when high-end homes prices in the area dropped rapidly, so the sellers ended up taking an offer for $470,000 less than the original agreement. Consequently, the sellers sued the original buyers to not only keep the deposit, but also the differential in selling price plus legal costs and other expenses. The judge ruled in favor of the sellers, and this whole unfortunate situation serves as a fairly straightforward example of what might happen if a buyer doesn't follow through on their purchase agreement. You can imagine that if the seller was also unable to close on their own purchase, there may have been a messy domino effect or chain of claims that could land on the lap of that original buyer. This is definitely not a situation that anyone wants. While this story is in the news right now because of the large damages involved, even when prices were climbing like gangbusters, there was always a very small portion of transactions that resulted in similar legal wrangling as a result of buyers not completing their obligation to close. I'm often asked if this means that the deposit automatically goes back to the seller, and the answer is no. This is because buyer deposits are held in trust and can only be released when the transaction closes, or when both parties agree to the release, or when a court orders the release of the deposit. Thus, in the event of incomplete transactions, either the seller or the buyer may need to file a claim through the courts. While this story is useful for learning a bit about what happens in an incomplete transaction, it's primarily a reminder to buyers to ensure that they have full vetting and support of a skilled mortgage professional before submitting an offer. There is a big difference between a quick mortgage pre-approval from an advisor at a bank branch and a thorough qualification and assessment from a true mortgage pro. This is also a lesson for sellers to take a moment to vet prospective buyers before accepting an offer, because even though deposits in Toronto are typically in the tens or hundreds of thousands, nobody wants to go through the time and process of having to make a legal claim. The final news story I'll chat about isn't as sad and comes via a study released by CIBC economist Benjamin Tal regarding recent Toronto condo investors. They concluded that of the 48% of condos bought by investors last year, 44% of these have a negative monthly cash flow when they go to rent out their units. Many real estate critics jumped on this, questioning what kind of investment is it when you have to essentially subsidize the living costs of your tenant by hundreds of dollars a month. The answer lies in the combination of four factors. First, the mortgage principal paid down each month is typically less than the monthly input by the investor, so in effect there's a bit of forced savings taking place. Second, rents charged to tenants continue to increase, up an average of 11% for the last couple of years. Third, there is an expected capital appreciation on the value of the property. And fourth, even the capital appreciation rate of the property is even if it's only in the single digits, it is amplified thanks to borrowing leverage. This is a biggie, as there aren't any other investments out there that allow 80% leverage, with a cost of this leverage coming in the form of interest rates still running under 3%. With that said, it doesn't mean that you're going to find me at the next real estate expo hawking condo investments for every man, woman, child, and kitten. There are a bunch of factors and scenarios to assess whether paying into a condo investment every month makes tremendous sense or no sense at all for a particular investor, and to get the answer means the investor and their realtor should be doing a bunch of math. Moving on to the numbers, Toronto had 2,797 sales in March, down 34% over last year. Even if you disregard last year as exceptional, we're still well off the level of activity that I'd expect at this time of year, and across the GTA, it's the lowest March sales since 2009. A good question to ask is whether this total sales measurement is really good for anything other than creating shocking headlines. The answer is that the number of sales is meaningful mostly when compared to the number of new or existing listings. It's this combination that gives us the months of inventory and sales to new listing ratios, which help identify whether it's a buyer or seller's market and to help predict the direction in which prices may be heading. Doing this for detached homes, we get 2.3 months of inventory and a 48% sales to new listing ratio, which are indicative of a moderate seller's market. For condos, we get 1.2 months of inventory and a 71% sales to new listing ratio, indicating a market strongly in favor of sellers. Worth noting is that because Easter weekend coincided with the last day of the month, these numbers are skewed a bit by sellers who delayed listing until after the long weekend. As a result, we've had roughly a 10% spike in inventory levels in April for both condos and freehold, and these stats are actually trending slightly more towards the balanced range. Let's move on to the more important question of what prices are resulting from these transactions. For detached homes, the average sale price was $1,293,000, which is down 17.2% compared to last year, and now starting to climb slightly since the start of 2018. As I keep saying, for detached homes, a good chunk of the year-over-year decrease is attributable to the fewer number of high-end sales, as evidenced by the home price index, which is only down 6% in comparison. The good news for the detached home sellers is that the HPI is continuing its 3-month streak, trending upwards, up another 0.9% month over month. As for semi-detached homes, the average was $1,032,000, down 5.3% versus last year. Where I am here in the beach typically comprises 10% or more of the semi-sales, and even though prices are up here, other pockets of town are weighing down the overall numbers. Looking now at condo townhouses, they came in at $651,000, down 1.6% versus last year. And finally, the average sale for condo apartments was at $590,000, up 7.2% over last year. Downtown condos are up an average of 13%, and the citywide HPI for condo apartments is up 15.9% year over year, with a couple of pockets in the inner suburbs showing increases of over 30%, but comprising only a small proportion of the overall inventory. With all that said, what's the bottom line on what's happening? It's still a story of the condo market, less expensive price points, and homes closer to the core finding more demand and multiple offers, while the relatively higher end and further out from downtown not experiencing as much love. While some segments are pretty tight and heated and contrasting segments are taking time to sell, overall I see buyers and sellers are motivated yet not frantic. It's a balance that will hopefully gain further traction as the market continues to shake off the craziness and disruptions of the last year. And on that note, I'm going to remind you to hit me up if I can be of any help with your residential real estate needs. You can reach me by phone or text at 416-357-1059 or online through RebeccaLang.ca. If you wouldn't mind liking the video and even commenting below, I really appreciate your feedback. My apologies for the indoor filming location this month, but our ridiculous weather was a bit too violent for filming outside this weekend. Thanks again for watching, and until next time, I'm Rebecca Lang, Toronto real estate broker.